Welcome to another session. Another one that I'm really looking forward to. I think this is a really important topic, with focus on consumer duty at the moment. So the session that Catherine's going to be taking us through today is the perks and pitfalls of client review meetings. As usual, questions in chat or questions at the end, and I'll probably take a kind of co-host privilege at the end and ask a question or two myself. So over to you, Catherine, and I'll go off screen as well while you're presenting.
Fantastic, thank you. And thank you for saying that, because it shocked me one time when you went, I thought, oh no, I've lost my co-host. So appreciate that. So yes, obviously, thank you everybody who's tuning in and watching or watching this on playback. So today we're going to be talking, I say, about the perks and pitfalls of client reviews. Client reviews are incredibly important. It's interesting with client reviews because some people can really query the commerciality of it. Is it worthwhile for my business and things like that? Am I actually going to get anything back from this? And whilst there can be a little bit of a hit and miss in terms of, financial return, sometimes with these things, we need to be very mindful, as Lee said, of something known as consumer duty. Now, most of us are aware of consumer duty. It has been, though they have been the buzzwords for the last, must be coming up towards 2 years or so now, and it's everywhere. And it's basically saying, be good people, in a sense, don't do anything dodgy. Make sure you're doing everything in the best interest of your clients, which the majority of people, and I would suggest probably the people who will be listening to this webinar are already going to be pretty much there and know exactly that they are doing everything at the heart of what they're meant to do, because that's the very nature of you being someone who would come and listen to a webinar like this. So what's really interesting with consumer duty is that consumer duty, it doesn't set in stone what we need to do. It gives us this really open kind of broad statements of saying we must do right by our customers and make sure we're continuing to do right by them, which does kind of bring us towards that thing of like an annual review or some kind of time frame for reviewing. Now, in the pension space, investment space, things like that, doing annual reviews is pretty much part and parcel of the job. So, it just kind of sits there, and, the good advisors will be doing that. In the protection space, as with anything, protection's just been left to do its own thing. You don't need to have qualifications. You can start giving advice on gift planning, protection, IHT protection with 20 minutes training, just walk in the door somewhere and someone says, here you go, give, people information on life insurance and stuff like that. There is no requirements whatsoever, which is really scary. But there's also then no requirements in terms of annual reviews and things like that. So it all comes down to what you as a firm or as an individual are prepared to do and what your resources will allow. But you do need to really be bearing in mind, you might be thinking, can I be doing this? Do I have enough time for this? Is it actually am I going to lose money because I'm going to be spending so much time looking after these people instead of the new people? And, it's quite tricky. It's quite tricky to find a balance. And as I say, it's going to be a mixture. If you're going to get the positives, you're possibly going to get some negatives. But what we're going to be talking about today is very much the reasons as to why we'll be doing it, the positives of us doing it, but then obviously naturally the negatives that can come with it. And the negatives, not necessarily from a commercial sense, but how things can go very wrong, how you can end up being in like a complaint situation. So it's very much a kind of like a safeguarding session on what you need to do. So I'm coming from quite a compliancy point of view. Don't turn off. It isn't going to be full on, compliance. But it is going to have quite a compliance-based background to it. Obviously, you must go by what your compliance people say, what you're authorized to do. I'm hopefully going to be giving you ideas as you go along as to some of the ways that you should possibly be changing your reportings to your clients, how you maybe be looking at these reviews, sort of seeing, is there slightly different ways that we could be doing things? And as always, I'm talking from a protection insurance point of view and angle, because that is where my specialism is. And also because, quite frankly, a lot of the time it kind of gets forgotten about. It gets left to be in the background and people don't take it particularly seriously because you don't need to be qualified to do it, because you don't need XYZ permissions, and certain rules and regulations don't apply as they do to other areas. And I think that can have a real knock-on effect as to the mindset of how we will be looking at it and just how wrong it can go for clients too. So when we're talking about client reviews, you've probably all heard the word churning. So churning is very much frowned upon, and we wouldn't be, any good firm would not be doing what's known as churning. Now, churning is something that insurers do look out for, and you can lose your agencies for it. So let's say you've done a client, I'm going to pick random numbers, £100,000 of life insurance over 20 years, and it costs £22 a month. And you might be fee-based, you might be commission-based. And if you're commission-based, there is sometimes a temptation to leave annual reviews to a 2-yearly or 4-yearly timeframe, because of the fact that that would be when your commission stops, your main bits of, or your commission liability. If you are an indemnity-based commission advisor, then it would be a case of your clawback period is gone. If you're non-indemnity, then you don't have that clawback period. But insurers watch out for that too. You've set up a load of policies and they have a 2-year clawback period, 4-year. But all of a sudden, your retention rate with them suddenly drops at those timeframes. They are watching. And, if you were doing something like for that client, so we've done 100,000, I think I said 20 years, and it was £22 a month. Well, in 2 years' time, you do 100,000 over 18 years for £19 a month. And you've maybe done a bit of commission sacrifice to get it to £18, which you probably will have done because the client's older. So you're not necessarily going to be able to get it cheaper unless there's some kind of risks that have disappeared. Again, insurers are watching that. And if they start to suspect it, they kind of have a bit of a natter with each other as well and start, it's that kind of thing. So we need to be really, really careful of that, because one, it's not right to do that to the client. Obviously, it is always nicer to give them cheaper premiums, but we need to be doing it for a real reason for the client, not just for getting more payment from the insurers. But also there is then that commercial aspect of, you might just simply have your agencies shut with the insurer, which is not positive. That is potentially going to have a knock-on effect with other agencies that you have. It's very unlikely that you'll get that agency back. So the positives and the reasons that we are doing these renewals is there's quite a lot. As I said, there's more disadvantages. So I don't want it to seem like a negative session, but we just need to be careful of certain things. So the positives are that we have, we're speaking to the client, we're getting an update on their circumstances, we're making sure that the insurances are still relevant for them. So life insurance, they maybe took it out on the mortgage. Have they paid a massive chunk off their mortgage and actually, there was potential for them reducing the sum assured on that? They might want to keep it higher, and you would really discuss that with them because there are advantages to keeping it higher. But could you drop that down and then their premium really reduce, which, they're going to be very thankful and they're going to be very happy that you've done that for them. With income protection, has their salary really increased and they need to have it completely reviewed because it's suddenly jumped up quite a bit? And even with things like just known as guaranteed insurability options, where we can maybe sometimes get things done in the background to help and just increase the policies without further medical underwriting, that doesn't always account for how much these salaries can potentially change. For critical illness cover, and this is a massive one with critical illness cover claims. Now, we are the experts in things like critical illness cover and stuff like that. And we tell people, this is what you're insured for. Here are your documents. If this happens, if that happens, speak to me, speak to the insurer. We will get a claim going forward. But no matter what, as with a lot of these things, these are documents that get put in a drawer somewhere and people don't realize and they forget. And sometimes they don't even think about what something is. So we have, there's 2 specific cases that come to mind for me where there was somebody where we'd contacted them at a review stage. We're chatting away and everything. And they just went, oh, well, yeah, I was diagnosed with an acoustic neuroma. And it was straight away, and you should be vigilant for this as well when you're speaking to clients. It's straight away that pause of, you had acoustic neuroma diagnosed? Yeah, and what? So what happened? Okay. Well, you've got critical illness cover. And they're like, yeah. And it's like, well, acoustic neuroma is claimable on this. Is it? And, we went from this person having this happen, not, obviously sometimes, acoustic neuroma doesn't scream out specifically a listed condition on that critical illness set, but it is sat in there in those conditions. And, this person got £500,000 paid out that they weren't expecting, just because we reached them at the review stage and said, we need to be claiming for this. We had something similar with somebody with rheumatoid arthritis. They'd been diagnosed with that, had no idea that they could claim on the policy. And again, we got them that payout. So it's not just about getting that policy set up and making sure that everything stays right for the client. It's making sure we spot those opportunities that are going, this is what we've done this for, this is what it's designed for, and we need to get this going forward. We need to get a claim going forward. Key things with reviews as well is that we're going to be protecting clients from scammers. I'm sure that all of us have at some point picked up the phone and heard somebody say, hi, I'm, from the insurance company. You've got an insurance policy with this one, this one, this one, this one, or this one. It's one of those, isn't it? And you can't, obviously, as someone trained in the industry, you're just like, okay, come on. Quite a lot of people aren't. And I have to say as well, it's really important to bear in mind that somebody's maybe their intelligence that you think they have because of the fact that they're doing this kind of job or that kind of job, even though job and occupation does not denote intelligence. But, you know, you might think, well, they're earning this amount of money or they're in this kind of level of management. They surely wouldn't fall for something like this. People absolutely do. And you can sometimes find that people who are higher salaries, who are incredibly busy, who are running big businesses, they're so busy that sometimes if they're contacted by this, they're so busy that they just kind of start talking. And they don't think sometimes about, well, actually, how does this person know this? And one of 5 insurers? No, I've only got a policy with 1 insurer. I better contact that person that set this up for me. They don't necessarily think about that. And it might be something that we obviously are trying to able to stop by reminding them regularly to say, I am here. I'm the one that's done this. If you need any changes, if anybody's contacting you and it's not me, it might be legitimate, but just chat with me first. We might as well, positives, huge positives with reviews is that we might see significant premium reductions. So you tend to find that obviously mortgages often, well, let's say 25 years on average, when they get towards the last 5 to 10 years or so, the mortgage itself massively drops in terms of the what's owed. And you'll see if you look at insurance policies and you kind of mirror the way that they drop, the things like the life insurance critical illness cover for covering a mortgage, if it's decreasing, the mortgage will be doing this and the insurance policy will kind of be staying up here. It gives quite a buffer for quite a bit. And so you can find, especially when you're getting towards those later bits, that actually, you know, you can either reduce the sum assured quite significantly and still be covering the mortgage, which for some people is incredibly important. Every little helps kind of thing. We need to make sure that we are paying for what we need, not overpaying, you know, maybe not paying for things that we don't need, even though, as I say, there can be reasons for keeping it a higher amount, just because you might say, well, actually, there's more in this now than what the mortgage is, but that could go as just like some additional family protection. The key thing is just to give the client the choice. You've also got things like somebody who's maybe been diagnosed with cancer in the past, and you maybe had a premium increase at one point. There are times that those premium increases will stay. There are times where they've been ridiculous premium increases, known as what's known as a per mil rating. And you might now be at a time frame where that rating can go if you look at it now. And, you know, that can be, again, huge. You can potentially save hundreds of pounds a month for somebody just because of the fact that they're now more of a time frame since a certain diagnosis. There are certain conditions where when someone's had them, the likelihood of improving the underwriting outcome is not going to happen because there's something that's more a long-term condition. So it's more likely that that condition will progress. But there are instances where we've had acute situations where we can really, really get positives. Another thing there is exclusions, especially with income protection. Someone's had a wrist exclusion because they got a bit of repetitive strain injury 5 years ago. Well, can we review it now and can we have that wrist exclusion removed? And you might think, well, it's a wrist. They weren't too fussed. Far better for it to be removed than not. And a really key thing here as well is that obviously we do have the consumer duty. We do have that need to make sure we're doing the best for our clients. If somebody came to you, like the FOS, let's say Financial Ombudsman Service, and they said, right, someone's complained about you because you did this review or you didn't review. And actually they found out that they could have now had this policy without this exclusion on there. And they've now got a situation which would have been claimable on if you'd reviewed it. Do we think that we would stand up against a complaint in that situation? No, because you know, if we're saying that, well, I can do this policy and I can do this, and I'm an expert in this area, then we should be doing everything possible. Or there is that thing of signposting. If you're not sure what to do, if you've run out of the resources, you know, we shouldn't not be reviewing clients. It might be, you know, you don't want to necessarily give your clients completely to someone else, but it might be for things like the protection side that you do get in a specialist who can just be there, help, especially help with those reviews. Maybe just say along the lines of that person's fine, that's doing exactly what it needs to do. There's nothing that can change. Or maybe saying, actually, we can step in and do something that's going to be a lot better here. So there's lots and lots of things that we're looking out for. You should, when you are doing reviews of clients, and this is reviews of clients are very tricky depending upon the area that you advise in. So obviously a lot of pensions, insurance, investment specialists will have, you know, your full IFAs will have a set number of families that they look after. So your review process is quite, I'm not going to say simple because I don't want it to sound like I'm saying simple, but it's quite straightforward. You've got 80 families, you're reviewing their cover, boom. Whereas a protection insurance, if you are just purely doing something like protection insurance or some other ones, you just have, we've got thousands of clients, absolutely thousands of them, because it's constant. It's new people. It's, there isn't like a set number of families because it's an ongoing kind of return in a sense that we'll be getting from these policies. A lot of the time, there's maybe what's known as a little bit of drip commission, a bit of renewal commission kind of there, but it's certainly not enough to sustain a business. So you are just constantly getting more and more clients in. So reviewing thousands of clients every year, very, very tricky. So you need to find up a process that can really work for you. So it could be, one of the things that we say is a good idea is, when you're looking at these reviews, it might be that you do phone calls and say, I just wanted to have a catch up. It might be that you do an email to say, I just want to remind you that you've got this policy in place. If any of these situations have happened, it's a really good idea for us to chat, or even if you just want to chat anyway, let's have a chat. You're getting your name out there to the client still, reminding them that they've got the cover, potentially reminding them as well of things like the value added benefits, saying to them, just want to double check, we set up this policy, did you sign up for that GP service, which was 24 hours a day, 7 days a week, access to GPs? Make sure that they remember these perks and everything. And you can make it quite standardized, but it can be very complex depending upon how many clients you have. And just trying to manage that, it's just the sheer volume that you are looking at. But there are potentially ways to do that. But what I would say is that if you're reviewing clients, if you're looking at a policy, it's a good idea to have something on their files that makes it easy for you to see, right, well, this person got this insurance, but it was non-standard terms. There was a plus 100% on the premium. There was a risk exclusion on the IP. So that when you're coming up to review it, you can look at it and go, right, actually, depending upon that situation, are we, okay, get the IP. We're now in time frame now where I think I can get that without a risk exclusion. And you maybe speak to an insurer and just say, do you think is this possible, kind of thing? And then speak to the client and see if they obviously want to have a look at that, if we are able to improve it. The pitfalls. There's so many pitfalls. I don't want to scare everybody, but there is definitely pitfalls. When we are reviewing clients' cover, this is our biggest complaints area. And even though I started to talk about protection advice and then the investments and the pensions and everything, obviously pensions, another huge complaints area, same with investments, things can go wrong. And sometimes things don't go wrong, but people still want to complain. And, that does happen. We are in an industry, in a society where, people have very easy ways to make complaints. And obviously that should be the case. People should be able to make a complaint if they're not happy with the service, if they think something's gone wrong. But it does also mean that sometimes you can do everything right and still receive a complaint and still have to spend that time to justify a decision, still potentially have to speak to the Financial Ombudsman Service, depending upon what this person's reaction is, what they're doing, which, is very, very unfortunate. But it is something that is part and parcel of working in the area that we are, and we just have to try and accept that that is something that's part and parcel of the business. So when we are replacing a policy, especially in protection insurance, we should have what's clearly defined as like a replacement policy declaration. That's how we term it in Cura. It does what it says what it's doing, so it works well. You might have a slightly different terming to it, but you really should have this. I would be suggesting as an A4 page in your report where it's just very clear, where we're saying, this is what you have, this is why we're changing it, this is what you've got now, here's the positives, here's the negatives. And so it's just really quick for people to see. It should ideally bullet points as well, draw people's eyes to the main points. Now, 99.9999999% of the time, you cannot replace a policy for protection insurance and say that it's 100% better than the original policy. It is rare to be able to do that, and I'll explain. And you might think, oh, kind of thing, because it's not nice to say that there's disadvantages, but we need to write them down. We need to make sure it's clear so that if somebody does say, well, they've not done this and they've not told me this and everything. What's interesting in protection insurance and other ones is that usually it is quite a requirement that we record all of our conversations. Now, I know with IFAs, that's not the case, which I find very amusing because it's like that industry kind of regulatory compliancy type assumption that IFAs completely trustworthy when they're having an in-person meeting that's not recorded, but protection advisors and other advisors as well, you must be recorded completely. You know, we need to be able to make sure at any point we can refer back to what you've done, kind of thing, which is it's really kind of like, okay, fair enough. But I'm personally very, very happy being recorded, because then at least I've got proof as to what I have said, and potentially what I've not said as well, because there's times that I wouldn't be saying things at times. But we're going to have the majority of the time, it can't be better. And I'm going to take you through some of those examples, because some of these disadvantages you should be including when you are reviewing protection insurance. So life insurance. The majority of life insurance policies in the UK have a 12-month suicide exclusion, which immediately means that if your client already has an insurance policy, life insurance policy, and they're beyond that 12 months, they don't have a suicide exclusion on there, majority of clients. So you've set up a new policy, we've got immediate disadvantage, there is a new 12-month suicide exclusion. And you might wonder, how does that sit? Well, unfortunately, during the pandemic, there was a very, very sad story. It was in the national press. Some of you might be aware of it, some of you might not be. And in that, there was somebody, an advisor had reviewed someone's life insurance policy, and they'd done a new one. They had not made the person aware that the new policy had a 12-month suicide exclusion. And it was around about 11 months into that policy that that person did take their life. From the insurer's point of view, that person didn't meet the definition of a claim. It was horrific. It was awful. It was a really, really bad situation. But ultimately, really, that comes down to the advisor, because the advisor should have made that person aware. You've got this policy. The new policy is this, advantages, disadvantages. A disadvantage is that this new policy has a 12-month suicide exclusion. There are times that that's not necessarily the case. So there are certain policies that can be arranged which have permanent suicide exclusions. So if you did a new one, it's an advantage in a sense that there's only a 12-month suicide exclusion. So it can change quite a bit, but that suicide exclusion statement should really be in there. There are a couple of insurers that don't have suicide exclusion periods, but the majority do. So you really, really want to be on top of that. And I say that would be, for the majority of the time, majority of people, a disadvantage. We then have things like critical illness cover. At Cura, which is my broker firm, I will not allow a critical illness policy to be replaced without something known as a CI expert report. Now, you might have different reportings for you. We use the CI expert because we find it very thorough in what we need, in the sense of I can go onto that system and say, right, you had a policy set up with this insurer in March of 2002, and I'm looking at a policy as of April 2024 with this insurer. And that system will do me a report which will say in a list form, this is what this insurer have, this in that policy, your policy currently has this, the new policy had this. It gives like a score to say which one's better, and based upon that system's rules. It'll then say, well, this one, the old one's better because of this, the new one's better because of this. In general, when you replace a critical illness policy, it is better, but you can't say 100% that it is completely better. And I'll give some examples. So some good examples here, because of things that people might not necessarily think of. HIV used to be a claimable condition under critical illness policies. The ABI did have it as one of its standard requirements, in a sense, to say that if you're doing a critical illness policy, you need to include this. Well, a couple of years ago, the ABI decided that HIV was no longer a critical illness due to the amount of incredible advancements that we've had in the industry. We've even got things like now where, you know, there has been the potential for life insurance at standard terms. There's potential for IP at standard terms, income protection, potentially getting critical illness cover too for people living with HIV, which is so far beyond what we used to have. Even just, it's from 2020, it has absolutely flown what the options are. So it's not seen as a critical illness anymore. So straight away, you can't say that the new critical illness policy is 100% better, because the new one won't cover HIV diagnosis. The old one does, the new one doesn't. We also have things like cancer. Some of the older policies had much broader coverage for cancer diagnosis, whereas now, obviously, we have lots more listed in certain ways and in partial payments in certain ways. And the new policy has just generally far more policies. I mean, we're talking usually at least on average about 60 conditions in a critical illness policy compared to what there used to be years ago. So overall, it'll be far, far better in terms of what's likely to be claimed on, but some of the definitions won't be as good at times. In all fairness, in that kind of an outcome, the price difference between when that person originally took it out compared to now is probably going to be the deciding factor to just keep your original policy, because obviously no matter what, the person's older. So that's another thing. You've replaced the policy, but they're older now. Well, it might fit their situation much better. It might be perfect for them, but it's more expensive. So the disadvantage is that it's more expensive. The advantage is that it's doing this and that and this, which the other one doesn't, but there is still the disadvantage that it's more expensive. The other thing that people might not think about with critical illness cover, and I'm just doing a couple of examples, this is the last one, is the fact that with quite a few of the, well, not quite a few, but some of the older critical illness policies for children's cover used to cover a maximum 30% or 30,000 for a children's claim. Quite a lot of policies now are, or for a little while at least, they were 25% or maximum 25,000. Some of them are now 50% or a maximum 50,000. And it can be quite confusing to suddenly, because you're doing all this stuff. I mean, obviously we're doing so much stuff, we're trying to compare these policies, and then you suddenly think later on, it's just like, well, hang on, did we check what the children's cover was doing? Has that changed? So whenever we're doing something like a critical illness policy, we need really, from a compliance point of view, I would be saying, and from a safety point of view for ourselves as advisors, we need to have some kind of statement there to say, this is what you had, this is what we have now, very clearly set out. Are you happy with this change? And then still in my replacement policy declaration, I will be saying, we have replaced, the critical illness policy. I cannot say with 100% certainty that this is better in every way, shape and possible form than your original policy. However, we have looked at the reports, we've looked at the comparisons together, and we both agree that this new policy gives you much broader cover. It's got more conditions that are, things like that. So you would come up with some wording with your compliance officer that would be kind of a standardized statement in your replacement policy declaration over that. Same needs to be said for value-added benefits. Value-added benefits change, they can be removed, they are non-contractual, so be very, very careful about the wording that you say with that. So you want something in there again to say, these insurances often come with some value-added benefits, such as mental health support, sometimes physiotherapy, different things like that. We have obviously these are non-contractual, they can be removed, they can be changed. And based upon this situation, I still feel that this new policy is going to be better for you. And again, speak to your compliance person for the right wording for that. Another big potential issue that we can have with replacing and reviewing policies, well, not replacing policies, but reviewing policies, is income protection. We are massively encouraged to do income protection, as we rightly should be, and really, really encourage and highly recommend to do it RPI linked or potentially CPI linked, depending upon what the insurer says. So basically, as time goes on, the value of the policy is in a sense retained. The premium will go up as well as the sum assured. You will usually find that the premium goes up more than the sum assured. So again, you might be 10 years down the line of a RPI linked income protection policy and look at it and think, hang on a minute, if I did this new, it's going to be cheaper, even though everything else is pretty much the same, because of the fact that the RPI, the very nature of the RPI with the premium is growing more than the monthly benefit. But a key area for the annual reviews for income protection is this RPI, because let's say we've done max sum assured, max percentage on that person's income, which is ideally what we want to be doing. And we should always really kind of start from that and then kind of work backwards to just covering bills and things like that. Again, do what your compliance person says that you're allowed to do. Different compliance people have different opinions. My point of view is, and in my firm, is that we will do as much as possible, because we're not just going to cover bills, we're also going to cover standard of living. Just because somebody is claiming on an income protection policy doesn't mean that they suddenly have to live in the house and, not do anything ever again. We want to make sure that they can still go out for their own mental health and things, and pay for potentially the hospital appointments, sometimes pay for the medicines. You'd be surprised sometimes that some conditions where you are able to get your medications in a sense for free, and some where you're not able to. It's very, very interesting when you end up seeing it. Anyway, often a bit of a tangent there, I do apologize. So let's say we've done that and we get to the next year and we're doing the review and the policy is going to RPI link. automatically, because they will do that. So you can say no, you can turn it down, but they will automatically go for it. And the person's salary hasn't changed. And we go and have the RPI linking done. Well, at that point, the person is insured for more than they are allowed to take, because their max percentage hasn't changed in terms of their income, but the insurer is assumed that their income has gone up, at least by RPI, and so they're paying for a high monthly benefit. And they're also paying an increased premium for that higher benefit. So the difficulty you have then is that, let's say a claim comes in and the insurer says, oh, right, so proof of income, we're doing that. Okay, well, their income doesn't match the maximum what they've been paying for. And you're like, okay, but obviously why? And then they're going to say, well, it's been RPI linked, but the salary's not changed. And we can't suddenly insure this amount per month because that means we're going past our max percentage that we're allowed to do. And then at that point, we've got that awkward situation of the client's been paying more, paying a higher premium for something they can't claim on. Now, the insurer's not going to say, oh, yeah, that it's happened. It's one of those things. Don't worry, we'll just reduce the premium. And, they will going forward. You can say, no, bring it back down. We want to do that. But you're not going to get those premium payments back to say, well, actually, they're going to say, well, you should have been keeping an eye on this. This was a maximum percentage based upon salary. And as the advisor, you should have known and you should have been on top of this. So we're going to have to be super careful. If you are doing income protection and you are doing RPI linked, then you really do need to be doing annual reviews with your clients. Other ones, there can sometimes be arguments to say, does it have to be annual? Should it be 6 months? Some people do 6 monthly. I think 6 monthly is quite intense. I personally wouldn't, for me, I wouldn't be too thrilled if my IFA was doing a complete review of my service, my systems, my finances every 6 months, because I just don't have time to be doing that. Very happy for the once a year thing. But you would, again, see with your company. But the important thing is to be consistent. You might turn around and say, well, actually, we can do 2 yearly. If you've got a reason to justify that and your compliance says it's okay, and there is a really clear justification for 2 yearly, then that should be okay. But there's no reason not really to be doing at least some kind of annual outreach. As I say, even if it's just an email to say, we're here, you've got this insurance through us, and, we should probably have a chat sometime soon. Do you want to? Not everybody wants to. The other thing to bear in mind as well when we're doing things and we're reviewing cover is, as I say, things like mortgages, but also, and income, any of these, clients' changes in circumstances. So we've got a client, they had their original policy set up, and let's say, let's go with the mortgage one just for ease. So the mortgage was originally 100,000, it's now 200,000. Let's just make it up. They've bought somewhere new and they need the new insurance. So the original policy is now maybe worth about 85,000. It's been reducing a little bit. You've been speaking to them, we're wanting to do the new cover. Now, let's say this person has had a diagnosis of cancer during that time. So there's a couple of options there. One, we might be replacing the full mortgage amount, which is very, very unlikely. I would be suggesting that's probably not going to be what you're going to do, as in a big hint of don't do that, in a sense. And because when we do that, not only is the person older, so the premium is going to be high, but they've had a cancer diagnosis. So our ability to be able to do it has significantly changed in terms of what the outcomes are going to be. Very, very likely to be at least some kind of premium increase along the way. And then the question is then, so reviewing it. So are we going to do the full policy? Are we going to do a top up? So we know that there's 85,000. We know we need 200. So we're going to do an extra 115 topped up based upon this situation. And again, in your replacement policy declaration, I'd be expecting it to have this is what you have now, and then the reasons for the new cover. So if it was that you've done the full new policy to cover the whole mortgage, I would expect you to put in there sort of we're doing it because you've got a new mortgage and you needed more insurance. But then I'd also expect a statement there saying, we could have potentially kept your original policy and topped up, but we've not done this because. So again, we're constantly thinking, can somebody be, could I be doing something wrong by this person? Could there be a complaint against me? So why haven't we just done a top up? Why haven't we kept, often a policy that's obviously bound to be somebody who's younger, but also there's probably not been any premium increases or exclusions on there. There might have been, but if there's been a change, especially in medical circumstances, it's very, very likely that we just want to keep that original policy in place. The times that it can be a bit trickier is if the mortgage terms increased as well. So if we had 100,000 over 12 years and the new mortgage is 200,000 over 23 years, that very, very much changes the situation. And we probably would be wanting to just do everything new, just because the original policy is going to obviously end far too quickly. The drop off is going to drop very, very fast as we get towards there. You can just do it as top ups, but what you're going to have to do is use what's known as an amortization calculator, and then to the best of your ability, try and calculate what's needed over the term and when the money will start to completely. It's fun. It's not fun in the slightest to be doing it that way, but it is something that you should be aware of. And also as well in those situations, it's kind of like, well, again, what are the disadvantages and the advantages? Well, the advantages would be, well, we've covered the full new mortgage, brilliant. But the disadvantage would be, it's more expensive again. Or, you know, the advantage of this is that we've done it this way because then you've been able to retain your original policy at cheaper rates and then just top it up rather than doing something brand new. So that there's lots and lots to be thinking about with that. As I said earlier, commercially, we are sometimes at a bit of a hit and miss. You know, you can start doing things and be reviewing and think, right, brilliant, I can do this for the client. This is happening, there's new mortgage. You know, I am going to get some kind of a return. I'm either going to charge a fee or I might get this commission from this insurer. And then you go into it, you start doing it. And I'm sure we've all had it where you get to the application and the person goes, oh yeah, I've had that. At which point everything changes and you might not be able to do anything. Their need won't have changed, but their openness to want that change could very, very much differ. And, you know, again, you might then go from the, we'll just replace it all to, oh, I'm going to have to just do like a top up here. And that top up, as I say, might be, you know, 100,000, it might be more than that, but sometimes it might be just 25,000, which is very, very different for you commercially, depending upon what you're doing, especially if you're more commission-based rather than fee-based. You know, we do see for ourselves, we do this quite regularly with our clients, and obviously based on my clients are generally people who will have had risk situations or health conditions in the past or still ongoing health conditions. And it is quite a mix between, yes, we can definitely do something, and then actually, oh, well, this is also developed and something new is developed. And the original policy just really does need to be kept in place. Another thing to be very mindful of as well when you are replacing is the potential for clients to cancel policies. So as we say, a lot of the time people set these things up, it's a PDF on the computer, it's a piece of paper in the drawer, and you remind them that they've got this insurance. Everybody is, I think the majority of people are struggling to at least some extent at the moment financially. You know, there is a lot and lot of people who are struggling financially, and literally, you know, even if the policy is £5 a month, that £5 can make a huge difference to somebody. And I get quite frustrated when people are sort of like, oh, it's just £5, you know, and it's really, everybody can afford that. No, there are some people who literally cannot afford that. It could be a choice between them eating dinner for a couple of nights or having the insurance, which from our point of view, the insurance is incredibly important, but for them, being able to eat is going to be far, far more important. And I do appreciate that clients in those kind of situations aren't necessarily going to be the clients that a lot of people listening to this would necessarily have as clients due to potentially, you know, certain asset requirements to be able to engage with certain advisors. But things happen, and you never know, sometimes things could happen, and maybe a client that you've had, something really, really bad happens work-wise or health-wise or something, and everything falls apart and they become that person who is struggling even to find £5 spare a month. So you get people and they're suddenly go look at it and they go, I completely forgot I had that insurance. Is that what that thing's been coming out each month? Oh, I don't need that. And you're then having to obviously see cancellations sometimes come in, and you contact them, and it's a case that there's a few things that happen. The most positive one for them is that they just don't need the insurance anymore. You know, we've contacted people sometimes and we've gone, we're thinking you're wanting to cancel the policy. Can we just check it? You know, we just want to double check from our point of view that it's the right situation for you. And they've gone, paid off the mortgage. I literally don't need it. It's like, oh. And you say to them, well, okay, I mean, obviously it can sometimes be worthwhile keeping, you know, it's not too expensive, you know, it's potentially a bit of, even though it's not family protection, how you would set it up, it does just sit there a little bit, you know, with a bit of potentially for a bit of funeral cover or something. And some people will go, actually, yeah, that probably makes sense. And some people will go, no, I don't need it. We're fine. And it cancels. So the brilliant thing is that they're not paying for something they don't need. And they're going to be walking away with quite a positive outlook over the insurance world, because I'm going to go, I had this when I needed it, I didn't need it anymore, nobody made it hard for me, and I've been able to make an informed decision myself. Fine. But it also, if those come in, it gives you a chance to review the client's circumstances. It can be that you can help them. Again, maybe a scammer's come along at the same time. You know, you might have said to them, oh, we need to review. They've gone on somewhere, tried to do a search. A scammer's got the details and got in touch, and you're able to save them from an issue. We had quite a specific one, actually, where somebody been diagnosed, I want to say it was Crohn's disease, and we'd got them life and critical illness cover, and it was very tricky to get them that. And this person, like I was saying before, you know, they were a manager, managing quite a lot of people. They were in quite a respectable job, and they had a scammer ring them. And this person was saying anything and everything about us and all this stuff. And this person contacted us, and he was just, I'm cancelling. How dare you have done this? You know, and all this kind of stuff. And we established that the scammer was telling them that terminal illness, which is a part of life insurance, was critical illness, and not what we had done, which was life insurance. You know, obviously, what this other person was saying to them was phenomenally cheaper. It didn't have critical illness with it. And, you know, we were having that situation of saying to this person, look, do I, you know, basically completely understand that you're angry. We're here to just tell you that what they have said to you is available is not available at that price. It just cannot be available at that price, because not even just because of they had Crohn's, just because of the very nature of the costings of life insurance versus critical illness. We were just like, it doesn't, they were like, we were like, we think that they've told you that terminal illness is doing this. It's not. We've done this. Here's the key features documents. If you never want to speak to us again, that's completely up to you. If you really are sure that we've done you a disservice, please just read them. Please read what they've sent you as well. And of course, the person came back to us and was just like, oh my God, I can't believe that I just fell for that. I'm not someone who would fall for that. And obviously immediately were fine with us, incredibly grateful for us, obviously still a client to this day, because of the fact that they almost lost this really valuable cover that had been very, very hard for them to get. And, you know, again, it's our responsibility to be there to make sure that people aren't being caught by these scammers. And you've got to bear in mind as well that, as I say, with these, so we've got the scammers, we're asking about, you know, potentially getting in touch with people. They might want to cancel the policy because they don't need it. There might be a scammer involved. Hopefully, we can make it a positive outcome for everybody involved. But you do need to bear in mind as well that you might be inciting, if you are commission-based, you might be inciting a clawback by reaching out to them. Now, under consumer duty, inciting a clawback is not a reason to not engage with your client, to not offer that service and offer them support. So you really, really do need to be looking at that. Obviously, if there's a cancellation, it could be that you're going to be getting an actual clawback properly from the insurer. It might be that your renewal commission might disappear. So you do need to think about the way that you're going to be approaching it. You are probably going to hear arguments from people saying, well, it could affect my commission, or it might affect this, it might affect that. That's not a reason. I say under consumer duty, you saying to them, well, I'd have got a clawback is not going to stand up against any kind of complaint that you receive. So you do need to be super, super careful about it. That's the majority of stuff that I need to say. So we've been through quite a lot of things. You know, we've been through the positives, obviously the client outcomes that are positive, the positives for us as well. You know, you might be speaking to somebody that maybe just needed a little bit of life insurance before, or income protection. We might now be in a stage where they actually need IHT protection. They might need gift protection. They might have set up a business and suddenly need shareholder and key person. You know, there's so much that can happen in people's lives, and they won't necessarily think a lot of the time, oh yeah, I'm going to, you know, come and do this and I'm going to do that. It's us that says to them, well, actually, do you realize that this is a bit of a risk area? Do you know that you need this? Do you need that? Obviously, we've spoken through all the majority of the pitfalls, the things that you should really be looking out for to make sure that you and your clients remain safe. But hopefully, Lee, that's been interesting, and you maybe have some questions for me.
That's great, Catherine. Really comprehensive, as always. So we've got time for a couple of questions. So one's come in. It's obviously from a wealth advisor. So the question is, with consumer duty, how much time would you think that a financial planner or a wealth advisor should spend on the protection element of the process?
Really tricky, because I don't know how much time they would spend on the pension and investment process. But you need to be doing it properly. You know, you really, really do. So certain things that stand out to my mind is, you know, sometimes I find that IFAs don't necessarily know that, you know, the gift protection, the gift into vivos policies are still available. They're not completely familiar with joint life second death term policies. You know, there's certain things that aren't, I'm not saying that they don't know about them, but they don't necessarily have, it's not their usual routes to access the insurance and having them there. What I would say is that you do need to treat it just as seriously as you would the pensions and investments. A key thing for me, I always go on about this, is income protection. I do appreciate that a lot of people, when they're speaking to an IFA, are usually quite a bit older. So, you know, they're already getting more towards the retirement age, or already there. Some IFAs I speak to just say, look, this person's so wealthy, they would never, ever need income protection, which, you know, sometimes that would be the case as well. But ultimately, things like income protection, you know, I always say to IFAs, when you're doing your planning, you know, and obviously as well, if you're doing cash flow modeling, hopefully there's some cash flow modeling there. Have everything set up for your client as to what you think is going to be there, and in 2 years' time, make one of them fall so ill they can never work again. Just cut out that person's income and see what happens to the cash flow, and go from there to then say, right, well, if that's what's going to happen, should we be looking at something like income protection? You know, as an IFA, probably more than anyone else in the industry, you are seen as the ultimate experts in everything, regardless of what you do. In terms of, if you don't do protection, you're still seen as, you know, because you're an IFA. It's that godly tier level of financial advice. So if there is somebody who's going to have an issue, you know, you're going to be thought of as somebody who should know everything about it. So there's no kind of thing like, for me as a protection advisor, I don't do pensions. I'm not authorized to do them. I'm not authorized to do investments. I know about them. I know about mortgages. I'm not authorized in any way, shape, or form. So I have someone I signpost to, or people I signpost to. So I can say, right, I've identified that I think there's something here. They need to be speaking to someone, and I've given them that information as to who they should be speaking to. So that kind of gives me almost a little bit of a barrier sometimes, because I can say, well, that is not my area of expertise. So nobody could tell me off for not discussing pensions because I'm not allowed to. Whereas with an IFA, you are definitely allowed to talk about protection insurance. You should really, you know, you should, if there is a potential for IHT planning, I appreciate that IFAs do have weird and wonderful recommendations that they do that don't always necessarily mean that something like a whole of life policy is needed, but it should be on the table to be looked at. It should be documented somewhere as to why haven't I done it that way? Because, you know, a life insurance for whole of life, for IHT protection or gift planning, for a lot of people is pretty straightforward, and it's not phenomenally expensive. Life insurance in itself, I mean, obviously when we're talking IHT, we are usually talking high amounts of money, but in the grand scheme of things, it is ridiculously cheap for what it is. You know, to the point that actually insurers have massively underpriced each other, and it's causing issues in some ways because it is so cheap, but yet the payouts can be so large. So just like I would do with my team, I would be saying to them, right, if you are doing this and that, I want to know, have you done waiver of premium? If you've not done waiver of premium, why haven't you done it? Have you RPI linked it? Why haven't you RPI? And I would expect that to be documented. I would be saying the same for IFAs. If you've not done protection, why haven't you done it? And it's not good enough to just say, client didn't need it. You know, there needs to be something to say, well, the client didn't need it because I am doing this, you know, because again, if you have a complaint, you want to be able, if someone comes in, to go, here's the file. I've explained exactly why I haven't done this. So I would be taking it just as seriously as anywhere else. You know, if you've got an area which we know could be a complaint issue, why wouldn't you? If I go from complaint issue, because I know sometimes people, if they're not going to do it because it's the right thing by the client, then sometimes to say it from the commercial aspect of, you could get a complaint. Sometimes that's what works, to go, do you want to face that? And we did actually help. We were approached by the FOS years ago, before Consumer Duty. I might have said this on the previous one, so forgive me if I repeat myself. And we were approached by the FOS because, and they said to us, we've had a complaint come in against a firm. Wasn't us, you know, but a complaint against a firm. I don't know who it was. So if you are that firm and you're listening, I'm sorry, but obviously we have to answer the FOS truthfully. And the complaint was that this person had died, and I believe they'd had a mortgage set up, and the advisor didn't do life insurance. And the family complained and said, why didn't you do life insurance for this person? And the advisor said, couldn't have it because of, you know, this. And obviously the FOS was looking at it and they were going, well, did you do any research? No. Why didn't you do it? Well, because they couldn't have it because of this medical condition. And obviously, being the experts that they are, they came to us and said, somebody with this medical condition at this time, would you have been able to insure them? And unfortunately, for the broker firm, and unfortunately for the family, the answer was yes, we would have absolutely been able to insure them. And so even before Consumer Duty, this was a complaintly costly area, and it's only going to be heightened more now.
Okay, brilliant. Thank you. That's really useful. So I think I've got away lightly this time, Catherine, because we're at time. But I will throw in one final question, because I think it's important. You know,
Yeah.
financial advisors. You talked about IFAs, and
Yeah.
there's very broad charts. You know, as I come from that
Yeah.
sector, you know. For those advisors less confident in the insurance side, because it's such a dynamic, moving part that advisors don't always address on a day-to-day basis the way you do.
Yeah.
You know, signposting, you know, we've talked about this a lot. How would an advisor who's less confident or should be doing what you've just said
Yeah.
think on their knowledge at that moment that that client may be uninsurable? How do they
Yes.
go and sign, you know, how do they follow signposting to get help?
Yeah, absolutely. I mean, there's a few things. I mean, we always say with anybody, and this is quite a thing with signposting, everybody always says, do it in-house first. If you can do it in-house, do it. If need be, you know, potentially get someone who is a protection. You know, I know there's definitely some IFA firms out there who've now got someone who is just protection, and that is all they do. And every one of their clients go to that protection person, which is brilliant. It works really, really well. But then not everyone wants to do that. Not everyone's got the resources to do that. Not everybody wants to do protection. Some people are just like, I do not want to get into that messy space. It's just, you know, because it can be very messy. Protection insurance is really at the heart of it. What you're doing is simple in many ways. You know, we're protecting against death, against the critical illness, but the amount of options are ridiculous. We've got I think about 35 insurers that we use. And that's UK, that's international, that's personal, business, group, you know, and each of them. And then when you get to IP and critical illness, the amount of options are phenomenal, and they change immensely as to what's available depending upon a client's risk. And for a lot of IFAs, I would suggest that you've probably got clients who are maybe skiing or sailing. They can make huge differences, huge differences. Amount of time outside the country as well. If they're going abroad quite a bit to those lovely villas somewhere, that can make massive differences as to what we're doing. Depending on what's happening with their tax as well, can really play into it. So you can potentially signpost. Obviously, there is Cura, which I'm at, which obviously anybody is more than welcome to chat to us. We do have lots and lots of people, IFAs, who come to us. About half of our business is from introduced situations. So this isn't something like, if someone's never done this before, it's not like a case of, oh, you know, is this something to be ashamed of? I'm not doing it myself. You know, does anybody else do this? Huge amounts of people are doing this, huge amounts. You know, I think we've got over 1,500 introducing IFAs with us at last count. That was the last time I checked it. So it'll be more than that now because we're just constantly more and more people coming. So you can signpost. And what that looks like is you speak to a firm that you like, that you trust, and you say to them, right, I've got a client. This is a situation. What can you do? And that's the usual route. And then the firm, that firm like us would say, well, we can do this. Do you want to introduce the client? And we would then step in and do that. Some firms just go, look, I've got a client in this situation, just chat to them. And they don't even want to know the next bit. They're just do it kind of thing, which is, again, it's fine. It's whatever suits you. But I think, you know, in terms of signposting, it's not something to be scared of, because sometimes I think people can be quite worried that it would make them seem like they're not smart enough or they're not good enough at their job if they need to signpost. But the way that I say it is that if you spoke to your solicitor and they said, right, I'm setting up this will for you, and I'm doing this and I'm doing that, and you need to speak to an IFA about your IHT potential because you need to be doing that. I have an IFA specialist here who can speak to you. You wouldn't second guess it. You'd go, oh, the solicitor said I need to speak to this person. You might choose your own person, but you'd be like, they've told me that I have this need. I need to do it. It's not their area. Someone else is doing it who is their area. And I think that's really key here. And you'd get it the same with the accountants, you know, would do it with the IFAs, you know, and accountants and lawyers do it together. It is one of those things where, you know, there's nothing shameful, or, you know, you're not doing your best job if you don't want to do protection insurance, or if you can't able to do protection insurance. You need to be doing what's right for the clients. And as long as you position it in the right way and just go, look, I'm here doing this. I do your pensions and investments. That's what I do day in, day out. So you know that they are going to be right on the money as to where they need to be. I don't do that. I don't have time to do that because I'm spending all my time doing this for you. That person over there is excellent. Use them. You do have things like, especially if it was like a medical or a disclosure that you were unsure about, there is what's known as Biber's Trusted Broker service. And so if you search online, Biber Find a Broker, and you can go on there and you can type in what you want and it'll show up loads of firms that have been authorized by Biber as people who are specialists in that area. And you can choose in terms of like location in the country and things like that. It's kind of like a random pop-up and that and things like that. So you can do that as to who, you don't know who's going to come up in the sense in the list, but there is that to potentially look to. Your network, if you're part of a network, could potentially have someone that you'd signpost to. We are involved with quite a few networks. So it might be that Cura are naturally the one that your network says use Cura, and there are other networks that use other ones as well. But key thing is have that conversation before you even get to the point, probably with that client, and knowing that a client needs that. Just have that conversation with the firm, find out what happens, find out what commercial arrangement is in place. There's usually some kind of a commission split that happens. Some firms don't want that. That's fine. So it could be, that you just do it. I'm not saying loaded premiums. This isn't anything to do with loaded premiums. It's just, obviously some firms are commission based, some are fee based. So it might be that you don't do a commission split, but instead, sometimes we have it where some firms want us to donate to a charity, if that happens, which is, happy to do. Some say, well, obviously, it's commission based. Just take a certain amount of commission off what the client pays, in a sense. So there's lots and lots of different ways to do it. Find somebody that you're comfortable with, go with your gut feeling kind of thing. And then it can really, really help. And again, with the consumer duty, you've then got a massive tick box in the sense of, why didn't you do protection for this client? I didn't do it personally, but I sent it to Cura or somebody, and they stepped in and did it. That means that, again, you're putting a barrier in place to say, I've done what I can do based upon my limitations. So I've got experts in.
Brilliant. Thank you. Really comprehensive as always, Catherine. So I guess we're slightly over time, but it's been a great session today. So thanks to everyone for turning up. Thanks for the questions. Thanks again, Catherine. And I really look forward to the next one.
Fantastic. Thank you, Lee. And I'll speak to you soon.